Ladies and gentlemen, welcome to the panel discussion on the future of sustainability in practice. To make this session more interactive, I'd like to start by asking the audience to take a short poll. You can view the poll on the right of this live stream window. Please select your preferred option and hit the next button to submit. I'm going to leave the poll open for a few minutes and take this time to share how GIC approaches sustainability. I will talk about 3 points. First, as a long-term investor managing the reserves for Singapore and for current and future generations of Singaporeans, sustainability is core to our mandate by design. We believe sustainability integration is imperative to the resilience of GIC's portfolio. Second, we believe companies with good sustainability practices will generate stronger risk-adjusted returns over the long term, and this relationship will strengthen over time. Third, we take a long-term and holistic approach on sustainability. We believe it is more constructive to actively engage companies to support them in their transition towards sustainability rather than to adopt a blunt divestment approach. In short, sustainability is and will continue to be an important theme for our lifetime and beyond. Today, we are very excited and honored to have the opportunity to learn from 4 esteemed panelists and experienced investors on what they do on sustainability in their investments. They are Jeremy Grantham, co-founder of GMO, Bob Litterman, chairman of the Risk Committee at Kepos Capital, Debbie McCoy, Head of Sustainability Investing in the Systematic Division at BlackRock, and Jaap van Dam, Principal Director of Investment Strategy at PGGM. First, I'd like to get each of the panelists to spend about 5 minutes to share your strongest views on this broad topic of sustainability and investing. Then we will spend the next 30 minutes or so on hopefully some interesting debates and discussions, and we will leave some time for Q&A with the audience after. Let's start with Jeremy. Jeremy, please.
Hello, I would like to cover 5 unrecognized long-term global threats. 5 in 5 minutes, all testimonials to our inability to process very bad news. First, Africa, politically incorrect. The UN says that the current population of 1.2 billion will be heading to 4 billion. I don't believe this for a minute. I think they'll be lucky to get to 3 billion. But even at that level, how do they feed themselves? They have the most degraded soils affected by climate change, poor governance in general, great distances. I think it will be a great push for immigration. We've seen how handfuls reduce the political balance of Europe recently. What will hundreds of millions do? Second, Al Gore's point on the feels like unbearable heat. That report says that 1.5% of unlivable space will go to 17. A lot of that is Saudi Arabian, sub-Saharan, but critically, it includes virtually all the Indian subcontinent. The paper does not draw that conclusion. That's almost 2 billion people in 50 years will be living on a continent that is making it almost impossible to get out and farm, to spend several hours in the open air, 35 degrees centigrade plus humid, potentially catastrophic. 3, the loss of global food production capability. The soil loss, parts of Iowa have gone from 10 inches of safety margin to 1 inch above what is required. There are only 30 to 70 good product years left around the world, depending on location. Increased heavy downpours from climate change are increasing erosion. Rising oceans are taking away the great river deltas so critical for rice. Increased droughts, floods, and temperature-resistant pests, increasingly degraded soil, declining gains in productivity, and compounds problems 1 and 2. 4, in the developed world, there is a population bust that is already going. Fertility is well below replacement everywhere, 1.7 in the US versus 2.1 required, 1.6 in China, 1.5 Japan, 1.4 Italy, an astonishing 1.0 in South Korea. The first component is choice, and the second one is postponement into less fertile age. But now we have unrecognized toxicity-induced low fertility. The sperm count in 70 years has dropped from 120 in the developed world to 40 units. There's no effect until 50 was reached about 10 or 15 years ago. And in that short time, now 15% of young couples in America need help. In 15 years, with no sign of decline, by the way, in the rate, the median couple will need help. This will lower GDP growth. The future will be 1 to 1.5% for the next 10 or 15 years and falling. Africa offers a balance on this issue, but politically, don't hold your breath. And fifth and most important is the near collapse of the social contract in the US, the loss of respect for neighbors, society, authority, science. After 70 rapid years of deterioration since World War II in the 50s when it was quite good, warned by Eisenhower and Schumpeter, the capitalist establishment would become too powerful, control the government, and use it to further increase its power. The workers have not shared in the US since the mid-70s, astonishingly. And the US has become the least equal of all the developed countries. It's justified by extreme Milton Friedmanism, supported by the Supreme Court. Government is hopeless, individualism can do everything, markets are efficient and all-powerful is the argument. All of this revealed as a farce by both climate change and COVID response in the US. No agreed policy, even on the wearing masks. It is a grotesque comparison to Southeast Asia and their much stronger social contract, but there's no time to cover that. Inequality and money in politics are key to the present problem, which is well-financed, clever, long-term propaganda of the vested interests, such as the fossil fuel companies' campaign to slow recognition of climate change. The cure is obvious: money out of politics and increased equality. Thank you.
Thank you, Jeremy. Can I get Bob to go next?
Thank you, Sumi. Well, first of all, my background is risk management. And so I'd like to talk about some of the lessons from risk management that apply to climate change, which is clearly I think the biggest threat to sustainability and the well-being of society in the long run. And the first lesson, which is perhaps the most important, is that we have to think about the full distribution of potential outcomes. Too often when we're investors and more generally folks think about the expected outcomes and don't take into account worst case scenarios. In the financial markets, we're very used to thinking about worst case, and there in many cases there aren't such a clear scenario that's worse. So what we talk about is extreme but plausible scenarios. And I think it's important in climate to think about extreme but plausible scenarios, which are really quite catastrophic. We're doing this experiment for the first time. In finance, we have a long history of relevant experience. Here we're moving into an area of complete uncertainty. And so when people think about how to respond to climate change, they have to think about those worst case scenarios. And that leads to the second lesson from risk management, which is when you're managing risk, time is a scarce resource. If we have enough time, we can solve almost any problem. When it comes to climate change, though, we have not been addressing it, and we're running out of time. And it's when you run out of time that a risk can become a catastrophe. The third lesson from risk management, and this was one that I think many people don't appreciate, is that the purpose of risk management is not to minimize risk. When Goldman Sachs made me head of risk management, they didn't want the firm to stop taking risk. What they wanted to make sure is that we got paid appropriately for risk. And in fact, all of investing is about maximizing return per unit of risk. And when we think about climate change, the fundamental flaw is that we're not pricing the risk. And I think that's well understood. The inevitable policy response is going to be to create appropriate incentives to reduce emissions. And that's what investors have to get ready for. I've done a lot of work myself on where to price climate change. And it turns out that the traditional economic answer, which is of course, we should price the externalities created by emissions, but the traditional answer is that the price should be low today and it should rise slowly over time and become a higher price in the distant future. When you take risk into account, what you realize is you have to be prepared for those worst case scenarios. And that implies a high price today and then responding to new information. The price doesn't necessarily go up. If you get good news, the price might go down. If you get bad news, the price will go up. And we don't know what the right path for prices are, but the expected path is a high price today that will come down as we solve this problem, as technology reduces the cost of removing CO2 from the atmosphere. The final point about risk management is, and this is, I think, maybe the most important, is economists often make a distinction between risk and uncertainty. And when they make that distinction, what they're really talking about is that we have metrics of risk, things like volatility or value at risk. And those metrics rely on models and they rely on assumptions about how the future will relate to the past. In the real world, we don't manage risk, we manage uncertainty, which is to say what could happen when our models are wrong. And so the implication of that is that you have to err on the side of caution. Now, with respect to climate change, I think all of these things mean we're recognizing that it exists, we're going to price it, but investors do not realize how dramatic that change is going to be. When we price risk and we think about where we need to price it, the analysis will show that there's going to be a phase change in the economy as we quickly go to a higher price on emissions. And what that means is that there's going to be a revaluation of the value of all of the different things in society. Certainly, folks focus on what I often call stranded assets, which are fossil fuel types of technologies. But more generally, there's going to be impacts in materials and transportation and so on and so forth. And it really will affect the entire economy. And that's what investors should get ready for. Thank you.
Thank you, Bob. Very interesting insights on how you price climate change risk in the portfolio. We can talk about this later. Next, can I invite Debbie to share your thoughts?
Yes, absolutely. And thank you for this invitation. I wanted to focus on just a couple of things in this introductory section. The first is the shared journey aspect of what I think so many investors are going through in thinking about sustainability. And the second is really an invitation to look quite curiously at the world around us, much more so than has perhaps been the case in the past. So I work at a BlackRock where I lead sustainable investing for our systematic teams. Systematic, when I say that, just means that we have an approach where we are quantitative in thinking about all of the measures that are in our portfolios and specifically sustainable investing. So in the shared journey part of what I'd like to comment on, I have found it encouraging and also difficult to look at how hard it is for investors really all over the world to start thinking differently. In the introduction to this section, you've mentioned the prior discussion, consumers, people in finance, companies, really existentially, we're all trying to deal with sustainable investing. What does that mean for how we think? I know that by the time I'm working with an asset owner all over the world, anywhere in the world, they will have been on a journey of their own and perhaps are making significant changes to investment policy to incorporate considerations that really were not in their framework before. That's important and it's a shift. And for us analytically, because we are focused on the quantitative side of investing, we necessarily think that we can add to this process by starting to enumerate and really look at the data around the issues that people care about. There's so much more transparency going on. Our research agenda has really come into 4 different areas. And I know that sustainability, ESG, there are so many terms that go together. But in the case of my team, we have found ourselves really in a search for characteristics of superior growth. characteristics that relate to risk mitigation, those that focus on economic transition, and I would include in that environment transition, but also some of the social transition that we're hearing about in comments already on the panel. And finally, some core social considerations. Now, I think it's worthwhile to consider, just for an introductory point, the reality that in the investing arena, I think the invitation to curiosity is a significant one. That we're all focused on these areas right now actually is unfortunate, because it means that over time there have been lapses. That actually in investing in the finance sector, we were not thinking as fully about the interaction between society and companies and returns. And so I know we'll draw some of these topics out, but from our perspective, I work in a data-driven team. We are able to use advanced analytics and a significant amount of data and information, as well as a lot of pretty sophisticated processing tools to consume information about the world around us. And for us, that expands the realm of things that we're able to look at. And for sustainable investing, we think that is required to take into account the human experience, to take into account the physical world, and to figure out what is the thing that will make our portfolios resilient, but also the world around more resilient. We want to reflect that. So thank you.
Thank you, Debbie. I guess one of the challenges when you think about ESG investing is the fact that data or the integrity of data can be an issue. So how do you do this in quant investing? I think it's something that we can talk about later. Finally, can I invite Jaap to also share your thoughts, please?
Yes, Sumi, thank you very much. Thank you for the invitation today to sit on this panel. PGGM and GIC have known each other for a long time, and I think the thing that binds us together is probably that we want to learn and that we want to cooperate. So I'll share my top 5 views on how to successfully invest in a sustainable way with you in the next few minutes. My first observation is that success starts at the front end of the organization. When you invest sustainably, you do that for the long horizon, but we still live in a world where we very much look at the short horizon. Investors and boards get very nervous when they do not produce alpha on a 2 to 3 year horizon. So you need to cover that gap. What helps enormously, I think, is a board which formulates very strong investment beliefs around sustainability and sticks to them. The executives of the investment management organization also have a very important role to play, create trust and stick to the path. And of course, what gets managed will grow. So there should be very clear targets and behaviors which come back in the scorecards of the actual investors. My second observation, sustainability and return generation often go hand in hand, but not always. Even if you have very strong convictions and beliefs about sustainability, and if you subscribe to the positive academic outcomes that Al Gore already referred to, you should stay aware that this is not a law of nature, and it's not the law of nature that sustainability and returns will go hand in hand. And this will never be the case. So even if you believe that sustainability and return and risk go hand in hand generically and on the long term, you should never mechanically apply this belief. Often many things have to coincide to realize better returns or better returns per unit of risk. For example, laws and regulation, technological development and consumer behavior. So never be a naive believer in positive outcomes. The third one, I think sustainability is more about better beta than about alpha. I believe that looking at sustainability as a source of short-term alpha creates the wrong frame and will lead to disappointments. Companies and the economy as a whole will gradually or shockwise move in a more sustainable direction. It's strategy, not tactics. The way to look at it is through a better beta lens, I think. A well-constructed portfolio will probably be more future-proof and resilient, and therefore have a lower strategic risk profile. On the longer term, this will create a more stable return stream and hopefully also higher returns. And at the same time, of course, it does reduce the negative footprint that you leave behind when you invest, which many people have talked about already, and is a good thing, I think. My fourth key point, sustainability is a journey. What we have learned at PGGM in the last decade is that sustainability is a journey with a number of stages of maturity. This is true for the organization as a whole, but also for the teams within the organization and even for the individuals within the teams. This probably means that you should start with small steps in areas where movement makes sense and on a scale that is large enough to create serious attention, but small enough not to jeopardize the overall results. We have also seen that some teams move faster than others, which I think is fine. So we typically start local in one or a couple of teams, for example, halving our carbon footprint within the equity portfolio. And then we export our knowledge and experience to the other teams later on. Push is often counterproductive. You should look for commitment, not for compliance from your investment teams. And finally, number 5. Make sure that you formulate strategic goals to meet. Many investment organizations treat sustainability still, I think, as something like an incremental layer on top of what they already do, an add-on. I think this often leads to suboptimal results and to greenwashing, which will not stand the test of time and also which will not stand the test of society, I think. And therefore, we try to work with long horizon objectives. For example, have a climate neutral portfolio in 2050 and a clear strategic plan with a 5-year horizon to make concrete steps over that horizon. This helps to create lasting change in a measured way and gives strategic pull to what you're doing instead of incrementally changing your portfolio. Thank you very much for this introductory remarks.
Thank you, Jaap. Very fascinating. As you can see, all our panelists all come from a very different background. You know, Jeremy Grantham will talk about the long-term macro impact on sustainability and how human sperm counts are plunging. You have Bob, who talks about the risk management aspect of looking at climate change. Debbie, of course, comes from a very quantitative angle. And then Jaap will talk about how sustainability or ESG investing should be better beta rather than viewing it as alpha. So very different perspective. Now, before we go into the discussion, I thought it's useful to bring up the poll results. So can we have the poll results, please? So there are 2 questions. The first question, is there a trade-off between investment returns and sustainability outcomes? 36% yes, 44% no, and the rest of 21%, I'm not sure. So if I were a journalist, I could spin the story the other way to say only 44% people said there's no trade-off. So I think you can see where I'm coming from. The next question is, what do you think is the best asset class to play the ESG theme? And most people would have already voted for equities. In fact, 41% in public equities, 27% private equity, some in infrastructure, 21%, real estate, 9%, others, 0.9%, not quite sure what it is. And of course, fixed income, the asset class that it comes from is, nobody loves it anyway. So there's only 1 vote for that. So that in sum is the output from our poll. And let's get back to the first question, which is this idea of the trade-off. So as an investor, doing well in generating returns for the clients versus doing good in ESG, the question is there a trade-off? Or if I can be more specific to ask the question, if and when there is a trade-off, what do you do? Can I ask Bob to comment first? Bob, you're on mute.
So sorry, having a little trouble. I don't think there's a trade-off. I think that if we think about climate change as one aspect of sustainability, it's a good example. And there, what we think is that emissions will be priced. That's going to be the policy response. And investors who see that coming, the real question is, how quickly are we going to transform society? And am I, as an investor, ahead of that or not? And if I'm ahead of that, then I can benefit both financially as well as doing well because I'm helping, transform society toward being more sustainable.
Thank you, Bob. So no trade-off. But I heard earlier from Jaap that there is a trade-off. Maybe I can get Jaap to comment on this question.
Okay, so and how do we deal with these trade-offs is probably your question. So first remark, I think there's a significant and growing body of academic literature that at least says investing sustainably will not hurt and may benefit performance. So that gives a very positive tailwind, I would say. And then rather than thinking about trade-offs, I think we prefer to think in a matrix form. So there will be areas where returns and sustainability will go hand in hand. There will be areas where they conflict, at least on the horizon that is relevant for you. And you have to figure out topic by topic, perhaps asset class by asset class, what to do. And what has helped us and also took away some nervousness at our board, if I can say so, is we always start very strictly from a financial first perspective. So we will carefully investigate what we expect to be the impact on risk and return when we go down a sustainable investment strategy, and the investment case should provide clarity. If the outcome is more noisy than we had, but there's no loss of signal, so we expect return per unit of risk over time to be stable or better, then we will get green light. If we expect that it will come at a loss of signal, then we will reject the project. And this gives a lot of hygiene in order to judge whether you should or should not follow the path of sustainable investing in a certain area.
Thank you. How about Debbie, from a quant perspective? Do you find that there's a trade-off between returns and ESG outcomes?
Well, what we find is quantifying what sustainability is in the first place is quite informative. So I think what I would offer, what Jaap has just said, is certainly aligned with a lot of how we think about individual insights, which is to test them and find out what do we learn. I think what I would offer to this question from an implementation point of view is if one begins with an assumption that a sustainable characteristic necessarily would not have a return implication, you actually can't solve the answer. I wrote with some colleagues a paper about this trade-off question about 18 months ago, because we do think it is central to determining how to implement these kinds of insights in portfolios. And the observations are really twofold. Number one, as I mentioned in the introductory remarks, if one is certain that there's nothing useful and sustainable for returns, you'll always think that there's an oppositional force, that this must be a hard trade-off. One of the benefits of working in a quantitative frame is that we can target multiple objectives at the same time in our optimization process. And I don't mean at the end of a portfolio construction process. There are a lot of decisions and trade-offs to make. So from the implementation point of view, what we find most useful is to embed the sustainability view from the very early part of our view about any individual security in public equities. So you have a couple of choices. You could say, I'm going to build a portfolio, and at the end, I'll modify it for what I think would make it look more sustainable. And that's not the choice that we make. In our case, developing proprietary research about the sustainability insights so that we can understand, they're in our long horizon research agenda, but we can understand over a long period of time what type of predictive analytics are available or knowable or discernible from these issues, and embedding them in our scoring of every individual security so that when we put together a broader portfolio and its optimization, we already have all of the sustainability characteristics built in. That takes the point of the trade-off away from thinking there's a non-ESG portfolio that is assumed to be best, and then we'll make it ESG. That just hasn't been sensible to us in our implementation. Rather, we're doing a lot of research on individual sustainable investing topics, using them to characterize each individual security because we understand the return properties of each, and then from there making the portfolio. So these are relatively important questions in coming up with a final portfolio outcome. We don't think people who are investing with us themselves want to make a trade-off between having returns or ESG. We think they want both. And this robust approach, we believe, gives us the ability to target these multiple objectives.
Thank you. Very practical, because you can put the two objectives into your optimization as one way to solve this question about trade-off. So the next question I'm going to ask is somewhat similar to the first question, but it has got to do with mandate design. So we know that we need large degrees of freedom and broad guidelines in investing. The more constraints and rules you have on the mandate, the less optimal it may become. So the idea of a sustainable fund, and even more narrowly climate change fund, which I believe Jeremy has also launched, I think in GMO, goes against that very belief and the principle of optimal portfolio design. Actually, I digged out a number. In a report published by NBIM in 2020, the exclusion decision in non-ESG compliant companies and investments has cost the fund 1.3% cumulatively since 2006. So the idea of having narrow focus funds like a ESG fund or sustainable fund, does that make sense? Maybe I can start from Jeremy.
If you jump around every year with different constraints, you will of course ruin any portfolio. Let us get it on the table that investment committees are the most conservative groups on the planet. Even at liberal universities, they have ultra right-wing investment committees. In the opinion of the investment committee, it has always been the case that if you tell them to do anything, any constraint, if you cough, it will ruin the performance. So finally, a few years ago, 20 years later than I should have done it, we actually tested this old wives' tale, old husband's tale, and because they're all men in those days. And what we did is we took out each of 10 groups from the S&P, leaving the investor with 90%, but leaving them consistently with the 90%, all the way back to 1925. So we had 9 portfolios, each of them missing a big 10% chunk. All of them did practically identically well. The market, it turns out, does a brilliant job of pricing equally the major groups. You cannot buy growth stocks and make a fortune over low growth stocks in the long run. The market does these jobs exceptionally well. And the one exception in recent years has been energy. Energy was 23% of the S&P in 1982. It is now 2.5%. It's the biggest deduction in value in the history of the stock market. And it's exactly in the direction of ESG and greening your portfolio. Otherwise, taking a group out consistently does not hurt, despite the stories to the contrary from the investment committee.
Thank you. Very insightful. How about Jaap?
I think I would reason very much along the lines of Jeremy. If I look from our perspective, then typically we would not aim for narrow focused funds. They create specific risks. And on the other hand, in our portfolios, in our case, we are very much passive investors, which also implies that we don't have a lot of degrees of freedom. What I would argue is this. First, in order to build a great portfolio, you definitely do not need to own the universe, the whole universe. You can cut out, like Jeremy said, big chunks of that if you do it in a smart way, I would say. And that gives you degrees of freedom to move. So my argument would be, yes, you can concentrate your universe a bit, but don't make very specific, small, concentrated pots, and be sure that you fully integrate your thinking about ESG in those pots. Of course, a very big question is then, how do you formulate your mandate successfully, your benchmarks, your incentives, etc. And then perhaps commenting a bit on your story about NBIM, the loss of returns because of exclusions. I would comment to that if you think about being a sustainable investor or asset owner, you have a lot of instruments that you can play. And disinvesting is not always the most productive instrument to play, not from a perspective of changing the world and not from a perspective of generating the best return per unit of risk. So my recipe would be choose the right instrument at the right moment, or combine them, of course.
Thank you. Can I get Bob to talk about it from the point of view of portfolio management theory, since you are looking at, you know, Black Litterman model as one possible way to do portfolio optimization?
Sure, I'm happy to. Well, I think the insight I would add is that an exclusion is not a very good way to run a portfolio. If you have a view that a sector or a company is going to have poor returns, you should have the optimal position in that company or sector, which is short, right? There's no constraint against taking advantage of a view. As Jeremy pointed out appropriately, you know, the energy sector has underperformed for a long period of time. A lot of people saw that coming. You could sell your coal companies, but that's not the optimal thing to do. You should go short the things that you think are going to underperform, and that's how you can generate alpha. So I would say it's a false dichotomy to say that you should either have exclusion restrictions or not. You should have your views about what sectors of the economy are going to do well, what companies are going to do well within those sectors, and construct your portfolio that way.
Thank you. I'm going to move on to the next question, which is really about the journey of getting to ESG for organizations. So the question is, how do you or your firm convert the skeptics and get people aligned and excited about ESG, especially for people who may be indifferent or agnostic to ESG issues and have done very well? What's the trick? So Jeremy talked about the race of our lives and talked about the evidence in toxicity and talked about this crashing fertility and plunging sperm concentration and so on. Is that what is needed to convert the skeptics, Jeremy?
I do think the race of our lives is an accurate analogy, and I think it's actually very American to get the competitive juices going. On one hand, the climate is clearly deteriorating despite our best efforts. We are, in that sense, racing towards the cliff edge. But on the other hand, the technology, and particularly in America, is making incredible progress, and much better than we ever dreamt 15 years ago in terms of solar, wind, battery storage, electrification. And the point about the US is that it's somewhat worse than the world in almost everything these days, except VC. In venture capital, it is still the powerhouse, risk-taking. It does more willingly than anybody else. The great research universities, so necessary to VC, it has a death grip on, 15 out of 20. And so that is a very appealing idea for the United States. Put your money into technology, into venture capital, and save the day at the cliff edge.
Thank you, Jeremy. Let's turn to BlackRock. We understand that BlackRock is on this journey on ESG and has really stepped up on your communication on ESG as well. Can you share with us, Debbie, how has the journey been and how does BlackRock do this?
Yeah, absolutely. I think the main thing that we do at BlackRock is offer options to those around us so that they can see what could be the implications of potentially investing in a different way. Certainly, it's not our decision how to invest our clients' assets. Each of our clients will have a decision of their own, but we do want to make sure that there are tools available. I'll speak specifically for how I contribute into that effort, and it's through research. So running a portfolio that's embedded with proprietary research about ESG and sustainable investing is truly the demonstration that exists. And let me just go a little bit further. Bob spoke earlier about carbon emissions and what might happen in the future. One of the things that I do in my research is think about carbon emissions, and along with colleagues, we've actually published externally with journals as well about this topic. what we've done is looked in the past to see what is the performance implication of lower carbon emitting companies, just as one example. We focus on issues beyond the environment, but in the case of carbon emissions, what we've seen over time is a strong relationship between company productivity, company performance, and carbon emissions. It's that kind of insight embedded into our portfolios. We also take deep consideration about how employees and their companies relate to one another in really trying to assess management quality. That kind of really detailed research ends up building up our knowledge so that we can say more in the public domain. And the way we talk in the public domain as investors is through our portfolios. So we think the best demonstration that we can offer in this journey is to have robust portfolios in and around sustainable investing and build research that can support that. So yeah, that's how I'm personally involved. And we know it's a journey for a lot of those around us.
Thank you. And yeah, may I turn to you? I mean, coming from Europe, obviously this theme is a lot more advanced compared to other parts of the world. But if you look at the journey that the rest of the world is embarking on, and talk about how organizations can get there, what do you see are the key ingredients for success to convert the organization into the ESG path? Do we need carrots or stick, carrots like incentive structure or sticks like public shaming?
Yeah, I don't like public shaming, so I'm more a carrot guy than a stick guy, I would say. If I may start with a small anecdote, I was working, I think, for a year and a half on trying to become a more internally a more sustainable investor, trying to influence teams, and nothing moved, nothing happened. This is more than 10 years ago. And then all of a sudden there was this TV program, it was called Zembla, and it showed that we invested to an embarrassing scale in cluster ammunition. All of the families of our investors jumped on the investors and say, hey, my friend, you are not, my husband, my father, you are not investing in cluster ammunition, are you? And this has really changed. So sometimes change has to come from outside. But a bit more serious now. I think, as I said before, creating the right culture is very important. Tone at the top, the attention, the way that you judge people. If you do that only on financial performance on the short term, you will never get there. The second one, I think, is generically, investment professionals tend to be very, very finance-oriented, financially educated, and I think that needs to change. So, for example, the CFA in the UK is now starting to integrate sustainability in its courses. I think that is a much needed thing, and you probably should do a lot there. Third thing, generically, we see, and I think, Jeremy, it was you who already referred to that, young people in general are much more close to the subject than other people. So put young people in positions where they really can build mandates and teams where they can integrate sustainability, and then you can export your results to other parts of the organization and to other teams. And lastly, and here comes the stick and the carrot again, I think shaming will lead to cynicism. And we are probably all reading Grow the Pie by Alex Edmonds. If you don't, you should. It's a good book, I think. And then he would say, I think you would want to build commitment and not compliance. Compliance is cynical and counterproductive in the long term. So build commitment of your teams, build buy-in, and that's a very strong recipe. If nothing works, you might sometimes need to hire different people.
Very useful tips. So I'm going to have the last 10 minutes talk about two questions. The first question is on opportunity and second question is on risks. Now, I come from fixed income, so I'm going to start with the downside. Can I get the panelists to talk about some of the risks or challenges that you think investors should be mindful of in the way they think about ESG investing? And can I start with Bob, please?
Thank you, Sumi. Well, I think that when you create your portfolio, and let's focus again on climate. And the issue for investors is how quickly is this transition going to take place? A lot of investors today are talking about being aligned with a net zero by 2050 portfolio. To get to net zero by 2050 is going to be a very rapid transition. The way it's going to happen, it will happen, but the way it's going to happen is that we're going to price emissions globally in a harmonized way. That's going to create different incentives, and that's going to affect the profitability and the valuations of all assets around the world. And so investors can see that coming, they can get in front of it, and they can make money from it, or they can not see it and not take advantage of it. When it happens, though, is it going to happen this year? Is it going to happen in 5 years, or is it going to happen in 10 years? It's hard to say. And so there's risk. We don't know when it's going to happen. I happen to think it's going to happen very soon. I think we're at a very close to a tipping point. And in fact, I wouldn't be surprised if there's a blue wave election in the US and carbon pricing legislation coming within the next 2 to 5 years. And once it happens in the US, and I think at a significant level, it will very quickly harmonize globally, because I think the rest of the world is ready to go. And once this happens, you're going to have everyone reacting to these new incentives: consumers, businessmen, investors, entrepreneurs, asset owners. And so I think things are going to happen much more quickly than investors today expect. They expect, but I could be wrong. That's the risk. The risk is you could put your chips on the table, hope for and expect a rapid transition, as I do, and things could happen. I have to tell you, I've been disappointed in how slow this has been. For I would have thought we'd be much further along than we are today. Although at the same time, as Jeremy pointed out, and as I and others have taken advantage of, you've done very well by positioning yourself for decline in the valuations of fossil fuel assets. I think investors are more and more realizing that this is coming and moving their portfolios.
Thank you. I'm going to rephrase my question a little bit to ask about the possibility of, call it, pitfalls in ESG investing. Maybe it's you're paying up too much for the ESG factor, or there could be a bubble in certain ESG themes. I wonder if Debbie have done any analysis on this.
We have. Your question is timely. It's something that I look at regularly. This question of pitfalls. I tend to think in the optimistic. So even as a risk, I'll offer this as an encouragement to anyone who is interested in this area. There are a lot of places where society and companies interact. And if there's something to be learned, it's that there's a stunning amount that we can absorb from observing the characteristics and interactions that relate to investment performance. And so a risk that we've actually all been holding, or really so many portfolios all over the world for a long time, is not having more carefully understood the relationship between broader society, companies, and returns. So that does mean, exactly to the point of your question, there can be areas of attraction that the whole world wraps around, and then some other areas which are probably equally important, which are understudied. And that's why in the research agenda that I've developed, I really have some balance between the economic and environmental transition, which is very much in the forward frame of attention, as well as other kind of more boring issues, but they really do matter, around risk mitigation generally, and identifying superior growth characteristics along with social issues. It has been the case, and I think the risk is to not look in a much more balanced way. Investors will leave a lot out, but also be subject to small run-ups, some of which we're seeing recently in areas that are drawing more attention. So I think balance is key in so many things in life, certainly in thinking about investing.
Thank you. Jeremy, would you have any thoughts about the risks that investors should be mindful of in sustainable investing?
I think in a group like this, we have a tendency to be much too narrow in our thinking and thinking about the portfolio. Having said that, I agree with everything that Bob said, but what concerns me is that the major risk is actually to our species. I think climate change and some of the issues I got into really do threaten our long-term survivability in a reasonably stable global civilization such as we have really had since World War II. I think that is under threat. It's already under threat. And every year it is getting worse. And I don't think it's clear that we're winning that particular race.
Thank you. Now, the final question before we ask, open the floor for Q&A. Exciting opportunities. What do you see as some of the exciting investment opportunities on sustainability? Now, you can be broad, you can be specific, you can have a long-term view or a short-term one. Generally talking about your best ideas and giving us tips to think about how to invest along ESG. Can I start with Jaap, please?
I think I will make short, and this is a kind of a plea. So in standard financial theory, I think we have largely accepted the fact that investors are exogenous to the outcomes of the world. We buy pieces of outcomes we call returns and risks. We combine them, and that we call a portfolio. I think the big shift that we need, and I think that's a huge opportunity for people like us around the table, is that we shift our minds towards thinking that you can actually change the outcomes of the things you invest in, be they listed, be they unlisted, everything. So allocate your capital in a very, very, very thoughtful way. If you put it in the wrong stuff, and I tend to say we have to solve all these issues that Jeremy has talked about in a quite short time frame. So if you allocate your scarce productive capital in the wrong way, you will produce waste. Not only waste for you as an investor and your beneficiaries, but also waste to society as a whole. So my call to action is let's recognize the role we play in allocating the scarce capital of this world in the right direction. Thank you.
Thank you. Bob, can you talk about some of the exciting ideas that you have in Kepos or other organizations?
Sure. Well, I'll give you one. It's rather narrow, but I think it's a great opportunity, which is the carbon allowances around the world, but particularly in California. You can buy carbon allowances that have a minimum auction price right below the current secondary price. And the state has created a 5% real minimum appreciation of that auction price right now. So basically you've got, now, of course, there's risk. And, in this case, it's political risk, I suppose. But I think it's during the COVID crisis, for instance, these allowances in the secondary market fell well below the auction price. But if you don't get the auction price, they reduce the supply. And so over the long run, you get basically a 5% real return minimum, plus the optionality of, if we do have a significant globally harmonized price, right now the minimum price is $17. I could see quite high appreciation of those allowances. Similarly, in the RGGI market, which is the US East Coast states, and then also the EU allowances. So, and China is going to come out with allowances soon. I think there's a lot of opportunity there. And I'll just say more generally, there's a lot of things called carbon assets, which tend to be, promises to reduce emissions. They trade very cheaply. But once again, if we're going to create a globally harmonized incentive to reduce emissions, let's say on the order of $50 a ton, then for someone who's pulling carbon dioxide out of the atmosphere, we should be willing to pay them to do that as well. And there's a lot of very cheap ways to create reductions in carbon dioxide. Now, they don't all scale, and that's why ultimately we're going to have a high price, because ultimately, I think one way to think about this is that every ton of carbon dioxide that goes into the atmosphere today is very likely going to have to be pulled out of the atmosphere at some point in the future. And so what is going to be the cost of that really tells you what we should pay for people who are willing to pull carbon dioxide out of the atmosphere today. There's a lot of ways to do that very cheaply. So those things, I think carbon assets and carbon allowances are very attractive today.
Very fascinating. I want to follow up on that, the trend of carbon trading. When do you see that taking off? Bob, if I may ask a follow-up question on your idea.
Well, right now, carbon trading is very illiquid. It's happening, but it's illiquid. And I think there's an awful lot of folks who are very focused on how can we create liquidity in these markets. And there are a lot of issues. It's a very complex problem. So perhaps not need to go into this, but I think there's going to be significant efforts that we will see over the next few years to increase liquidity in these carbon markets.
Thank you. Jeremy, I see you nodding your head when Bob was talking. And I understand that you invested a lot of your own money in venture capital to solve climate change issues. Can you talk about this?
Yes, I can. But first of all, thank heavens for California. They really set a good example in many ways. But two ideas out of venture capital and out of many, really very many, surprisingly many terrific opportunities. And they are kind of bioengineering of microbes. We're investing in attempts to do that to produce energy, to sequester carbon, to create protein and other food, and new materials. It is just a wonderful cornucopia almost of opportunities. And the other is fusion, hot fusion. If we can come back in 30, 40 years and have a plentiful supply of cheap fusion, all our problems will then go away. They might be pretty severe by then, but they will start to ebb. There are at least 20 or 30 second generation fusion companies, one of which we invest in, and they're making steady progress. I think it's quite likely that in a decade or two, one or more of them will start to produce something that is commercially useful.
Thank you. And finally, Debbie.
Well, the opportunity from my perspective is to use an enormous amount of information from the world around us to inform portfolios. So just as a couple of examples of why I think it's so exciting, in one portfolio, I have geospatial images of what happens after climate disasters to understand economic restarts, human development factors, so literally disease research about the impact of diseases on populations all over the world, and detailed management quality information, what's going on with management teams when there are controversies happening at a company. So I think the opportunity that I see is to bring more and more information about how the world really works and issues that are pertinent to our humanity, our personhood, and to the earth, all into the frame. Of course, that requires a fair bit of technology and sophistication for processing, but there's certainly a lot of information out there. I think for those of us who are responsible for investing, getting that into our portfolios in a way that's sensible continues to be a huge opportunity.
Thank you very much. Thank you all for a very fascinating discussion and debates. We hope you have enjoyed the discussion with us. Have a good day, everyone. Thank you very much.